Hey everybody, it's Nicole Johnson with CoVision Real Estate Group, and today's frequently asked question about mortgage notes is what is an investing in mortgage notes? So I created a video about this, but it was a long time ago, so I thought it would be a good idea to do a refresher video. So what is mortgage note investing? And to break it down in really simple terms is, okay, you're a homeowner, you want to buy a property, but you don't have the money to buy a property. So you reach out to your bank, let's say Wells Fargo. So you reach out to Wells Fargo and you say, hey, I need to borrow money because I want to buy this property. So Wells Fargo says, okay, we'll lend you the property, or we'll lend you the money to buy the property. We're going to create a mortgage with the terms of the agreement. And so you, in order to buy the property, they give you the money to do that. And between you and Wells Fargo, a mortgage is created with a deed of trust and a promissory note, and it gets recorded against the property. So you, as a homeowner, your asset is the property. Wells Fargo, their asset is that promissory note and mortgage. That's their asset, that piece of paper that locks in your promise to pay that money back. So with the terms of that mortgage, you're now making monthly payments as agreed upon with the set interest rate, usually a 30-year loan. With the set monthly payment, you're now making your monthly payment to Wells Fargo because you're promising to pay that money back. So that's the mortgage. So, but Wells Fargo, because they have that piece of paper, that's an asset that they can sell on the secondary market. Just like you as a homeowner, you could sell your property at any time. The owner of that note or that mortgage, they can sell the piece of paper. So you might be making your payment 6 months, 2 years, 5 years, and then you get a letter in the mail that says, congratulations, your loan has been sold to XYZ investment company. And now you start making your mortgage payments to XYZ investment company. That happens on a large scale with big bank corporations. It's called the secondary market. Mortgages get bought and sold and traded like that all the time. What can't happen though is the terms of that mortgage don't change. So the interest rate stays the same, your monthly payment stays the same, the loan term stays the same. The only thing that changes is just who you're now sending your monthly payment to. All the other terms stay the same. So that's what buying and selling mortgages mean. And so what happens on the secondary market is we can do that on a much smaller scale. So we're not large corporation like Wells Fargo buying, $350,000, $1 million mortgages. We're buying these smaller loans, a $50,000 loan for a piece of land, an $80,000 loan for a mobile home. So we're buying and selling mortgages from that route, and that's how we're investing in mortgage notes. So if you'd like more information on that, that's just kind of the overall picture of what it means to actually buy and sell mortgage notes. That's what happens kind of behind the scenes. But just remember, the terms of the loan never change. The monthly payment never changes. That piece of paper can just get sold to a different investor. And now that mortgage holder starts paying the new owner of that asset. So hope that helps. If you have any questions, feel free to reach out. Give me a call. Thanks so much.